Part A, state two differences between financial accounting and management accounting. And part B, explain product costs and period costs given one example of each. And that's a total of 10 marks. Very easy questions, but apparently some students didn't notice it in the exam. They went right into it, into the manufacturing account. Financial accounting reports to external users, example the owners, lenders, tax authorities, creditors, regulators, right? Whereas management accounting report to the internal users like managers and supervisors for planning, directing, motivating, and other internal uses. Okay, so this here, uh, you cannot use a table for this. If you use a table, with one column for financial accounting and another for management accounting, you will not get the marks because a table does not really compare and does not give differences. It just states the two items that you're trying to distinguish between. And Keep does not award you the marks for that. Okay. The second one is financial accounting reports mostly historical performances of the past year, whereas management accounting is based on providing information for making decisions concerning the future. Okay, so past performance here and future wishes, if you want to call it, forecast. Okay, so remember, do not put it in a table when you are asked to distinguish and use the keywords whereas, okay, or while or something, showing that you're distinguishing between the two. B, product costs are costs associated with the manufacturing of acquiring inventory. Example, wood in the production of wooden furniture. Okay, so your costs that are associated with acquiring or manufacturing, right? Acquiring would be purchases if you're a retailer, that would be a product cost. If you're a manufacturer, uh, you would have things like raw materials and your entire manufacturing account. The cost from there is product cost. Okay, period costs, a cost associated with the manufacturer or acquisition of inventory. It's unassociated. Okay, example advertising costs. Right, this is associated with selling and administration. Okay, right. So period cost is more related to the time element rather than the product. First, we'll do a couple of workings. Depreciation on fixtures and fittings is 5% of the cost, and 80% goes to the factory. So we get 10,800. Then we have factory machinery. It's on the reducing balance method. So we take the cost and we minus the depreciation from the trial balance. You may want to take a flip back and look at the data in the trial balance. And when we multiply by 10%, we get 25,000, and the entire 25,000 goes to the manufacturing account. First, we have the heading. Keeps like the heading done in 3 lines. Answering to the questions who, what, and when. The Silver Slipper Limited manufacturing account for the year ended 31st of the 3rd, 2019. First, we look at the direct materials. The opening start with the opening inventory, and we will add on the purchases. To that, we add the carriage inwards of 25,000. That is, we go add it as part of the purchases. and net purchases will be 345,000. To minus the closing inventory from that, and we get the cost of raw material use of 386,000. To that we add the direct labor costs, wages and salaries. 60% goes to the factory. Direct expense 70,000. So prime cost is 540,000. We continue the rest of it in the next slide. We add the factory overheads. Then we add the electricity, 75% of 180, 135. Insurance, 75% by 36,000, gives us 27,000. Rent, 85,000 by 250,000, gives us 212,500. Wages and salaries, 20% of 140, gives us 28,000. Depreciation and fixtures and fittings, we from our workings 10,800. Factory machinery depreciation 25,000 again from our working. So we get total manufacturing overheads of 438,300. Add that to our 540,000 of prime cost. We will get total manufacturing cost of 978,300. Then we make the adjustment for work in progress. We add on the work in progress at the beginning of the year because that would finish sometime during our year, and we minus the work in progress at the end of the year because that will go into the next year and be finished there. And we get a production cost of finished goods being 976,800. Okay, now I went through that very rapidly. You can pause the tape, pause the recording at any time, and check it out. Okay, there's another part C, that requires us to do something else. Silver Slipper had the option of purchasing items rather than making them. This requires the company to evaluate relevant and irrelevant costs in arriving at a decision. Distinguish between relevant costs and irrelevant costs, given one example of each. Okay, so we will look at next at the part 2. Part 2. Relevant costs are those costs whose incurrence depends on the course of action taken. These are the costs that are influential in making decisions and are taken into consideration when making decisions. Example, direct labor costs. In fact, all direct costs or variable costs are taken into consideration and are relevant costs. Okay, direct materials, direct expenses. Irrelevant costs. These have already been incurred or committed and do not influence decision making. Example would be depreciation. Okay, that has already been spent. They are sometimes called sunk costs. Module 2 coming up. Stick around. We are given some data here for Lucas Limited. They decided to respond to a request for proposal, so it looks like job posting. Traditionally, the company uses predetermined overhead rate based on machine hours to apply overhead. Markup on all jobs is 15%. Okay, I read it before. You will take your time and you will read it again, and we make reference to it as we go along. The company has 4 categories of overheads as follows. And we have inspection, ordering, power, and maintenance, and we are given the total cost for each item, the cost driver or the activity driver, and the quantity of the times that you use the activity. What we are required is to outline two differences between traditional costing approaches and activity-based costing techniques. And B, determine the bid price of product 427 using machine hours to apply overheads. So they want us to use job costing to get the bid price for the project, and then we have to determine the bid price of the product using activity-based costing to apply overheads. Okay, we'll continue with the response. Two differences between activity-based costing and traditional costing. Traditional costing uses total cost, whereas ABC uses cost per activity. Right? Traditional costing uses a predetermined overhead rate, QHR, to apportion overhead, while ABC uses an activity cost rate and cost pool. B requires the bid price of job 427. The PUHR we calculated first is the total overheads divided by the machine hours. So that gives us 1,640,000 divided by 200,000 equal $8.20 per machine hour. So we would use that now to calculate our overheads. We were given the direct materials as 50,000. You may want to pause the video and look back and see where that 50,000 is coming from. And the direct labor is 35,000. The overheads would be 2,400 machine hours by the $8.20 that we calculated up there, giving us 19,680. When we add it up, we will get 104,680. To that we add the 15%, which is 15,702, and we get the bid price of 120,382. So that's it for part B. We move on to the next. Part C asks for the activity rates. We take each one of the activity, like ordering, and we take the overheads for that and divide it by the number of the cost drivers. And we'll get 160 for ordering. Inspection is 430,000 for the overheads and 250,000 inspections. So it's $2 per inspection. Okay, you may want to pause the video and go back and look at these figures to see where they are coming from in the table. Okay, maintenance is $350,000 and 200,000 machine hours. We get $1.75 per machine hour. And then we have power 780,000 for overhead divided by 500,000 kilowatt hour, and we get $1.50 per kilowatt hours. These now we would use to allocate or apportion our overheads to the job 427. Calculation of the bid price using ABC costing. The direct material stays the same. The direct labor also stays the same because these are already apportioned. And then we apportion the overheads according to the activities using the activity rates that we just calculated. And we'll get 25 orders at 160 an order is $40. 50 inspections at $2, 100. 2,400 hours at 175 gives us 4,200, and power 7,000 kilowatt at 156 per kilowatt hour gives us 10,920. If we add it up, we get a total cost of 100,260. We mark up 15%, we get 15,034, giving us a bid price of 115,299. Okay, what you should do is go through these calculations on your own, ensuring that they are correct and that you know how to go about calculating activity rates and using them in a job costing. Part D, and this still deals with product 427. It passes through another two departments. We are required to, using the weighted average method, calculate the unit cost of for the quarter, cost of goods transferred, and part 2, calculate the cost of the ending work in progress for another 3 marks. Okay, let's take a look at the data. At the beginning of the last quarter, the cost assigned to work in progress were materials 256,000 and conversion 196,450. The following equivalent unit schedule was prepared for the first department for the last quarter when 350,000 units were completed. And we have here the equivalent units is already calculated for us, 48,000 and 24,000. And we are given some of the actual costs for the period. Okay, so it should be very simple from here. No elaborate thing. They do not ask us for a cost sheet, so we could do the calculations anyhow we want to do it. I like to do my calculations in a nice format like this. Okay, in a nice table, and you didn't have to do this in an exam, but this is more so that I can explain it to you all, right? When you take the physical units here, and you always account for the physical units. If you can't account for the physical units, you will not be able to account for the equivalent units. Okay, so the completed and transferred 350,000. It will be the same for 350,000 for materials and 350,000 for conversion. The equivalent units would be the same as that because they are completed units. The work in progress, we have 60,000, 48 for materials, and 24 for conversion. When we add them down, we get 398,000 equivalent units for materials and 374,000 for conversion. Okay, now we do not add these across. This here is just notional figure for balancing your units. Okay, and we look at costs, the work in progress brought forward. We put in these two and we add them and we get this here. Well, we could have done this without a table. As soon as we get the equivalent units here, add up the cost and divide it, and we will get the same thing as down here, right? Okay, but we also have to learn to do it in job cost sheets, and this is a good time as any. The materials added 599. We put it in the total column here, 599. Okay, remember we are no longer dealing with the physical units up here. We are now turning to the cost in dollars. And conversion 286, we bring it across to the total column here. We add them down, then we add these two across and we look at the total cost here. Okay, okay. Now, a crucial mistake that students make is to take this here, this and divide it by this to get the cost per equivalent unit here, and that would be a very grave error. How you get the cost per equivalent units is you take the materials, you also do them separately, materials from conversion, and you take the cost here, you divide the cost by the materials and you get $2.15. Then you divide the conversion cost by the units for conversion and you will get 127. When you add these two, you get this figure here. Okay, so this figure is not as a result of dividing this by this, right? If it turns out that this divided by this gives you this, that's just accidental. It does not happen all the time. Okay, cost of goods transferred, right? We will multiply this by the 350,000 and we will get 1204 units. The work in progress, we will multiply the 48,000 by $2.15 and we'll get 103,200. And the 24,000 by $1.27, we get 30,960. Right, when we add these two, we'll get the work in progress total here. Right, we do not go the other way around, taking this and multiplying it by this. Right, we might not get that. Okay, when we add these across again, it will come up to this, which should balance with this figure here. Okay, so the balancing nature of this worksheet tells you whether you have done it correctly or not, right? I've extracted the answers that they asked for. The unit cost for the quarter is 344. The cost of goods transferred 1204,000. The cost of the ending work in progress part 2 is a 134,160. And the materials 103,200 and conversion 1392. If you add these, you will get this here. We have here some data. Some of it is budgeted and some of it is the actual cost. And we are asked to calculate the following: break-even in units, margin of safety, the number of units that must be sold if the company wants to make a total profit of 4,306,500 for the quarter. Okay, so let's take a look at the data. Some of it is budgeted, as we saw, and some of it is actual cost. Now, for the break-even, margin of safety, and the target profit here, we will use the budgeted data only, and the actual data would be used for the other parts of the question, the variance analysis. First, the break-even in units. Now, as we go through the calculations, you may want to pause the video and go back and look at the data, okay? So you can get an idea of where these figures are coming from. Contribution per unit must be calculated first before you can calculate the break-even point, because the formula is fixed cost divided by contribution per unit. And to get the contribution per unit, the selling price minus the variable cost per unit is the formula. So in this question, the selling price is 23,000, sorry, and the variable cost per unit is the raw materials plus the labor plus the overhead per unit. And when we take that from the selling price, we will get 13,050 per unit. The break-even point then becomes fixed cost over contribution per unit. 5,128,650 is the budgeted fixed cost, and we must make sure we get the budgeted fixed cost here, not the actual, divided by 13,050 equal 393 units. Next, we have the margin of safety, and this is the budgeted production, 650 minus the break-even point that we just calculated, and it's 200, gives us 257 units. This is in units. If you want to get it in sales, We just multiply the 257 by the selling price and we will get the margin of safety in sales. Right? We have to be careful here that we take the budgeted production and not the actual production. Part 3, the target profit of 4,306,500. Okay, to get that target profit, we use a modified version of the break-even formula. We just add on the target profit to the fixed cost and we divide it by the CPU. So in this case, it's going to give us 5,128,650 and the 4,306,500 and then divided by the contribution per unit. And we will get 723 units we need to sell in order to make this amount of profit. Okay, so any target that you want to set, you just take it and add it on to the fixed cost and you divide it by the contribution per unit and you will get the target. Part B. Calculate the following variances: direct material price, direct material quantity, direct labor rate, and direct labor efficiency. So when we're looking at material, it has price and quantity. When we're looking at labor rate, we have rate and efficiency, but it's really the same thing. The labor rate is a price, and the labor efficiency has to do with quantity of labor. So all of these are basically the same sub-variances. Okay, so we will get right into the calculations, but these calculations would deal with the actual as well as the budgeted figures. Because to get a variance, you have to take the actual and minus the budgeted figure or the standard figure, and then you will get your variance. To calculate the variances, I'll be using these standard abbreviations. AQ would be the actual quantity of materials, SQ is the standard quantity of materials, SP is standard price, and AP is actual price. And for the labor, AH is actual hours, SH is standard hours, and SR is standard rate, AR is actual rate. Okay, at this point you may want to go and look back at the data for the standard and the actual figures in your past paper, because I would not be flipping back to it in the video. Now, in order to calculate these sub-variances, you have to know the formula using the abbreviations that I just gave you there. For the direct material price variance, you need to know this formula here. The actual quantity multiplied by the actual price minus the actual quantity multiplied by the standard price. Okay, if you notice AQ and AQ is common to both of them, so you can take that out and you'll wind up with AP minus SP. Okay, and you can work it out and you will get 47,000 favorable for the direct material price variance. Now, if you didn't know this formula before, I would suggest that you learn them before you go into your exam. Learn it by heart because they may not give you this. I haven't seen them giving this out to students in an exam. So you have to find some way of remembering it at first. And I would suggest that you memorize them. You don't look to see if you can remember it or logically find it out during the exam itself. Part 2, the direct material quantity variance. The formula for this one would be actual quantity multiplied by standard price minus standard quantity multiplied by actual price. This time we're dealing with the quantity, so you have the quantity being common to the price would be common to both of them, right? And you'll wind up with the actual quantity minus the standard quantity inside of one of the brackets. So when you work out this, you're going to get favorable variance of 862,500. Now, how would we know that it's favorable? When we look at the actual and the standard, the actual is less. Okay, so we know that it's favorable. 3. The direct labor rate variance. The formula is actual hours multiplied standard rate minus actual hours multiplied by actual rate. And again, we can pick out the common ones, actual hours, and we can put it outside the bracket, and inside the bracket we'll have standard rate minus actual rate. And work it out again, we will get 855,000 for our variance, but this time it's unfavorable or adverse. We could have a A here for adverse as well, and the reason for that is because this time the standard is smaller than the actual. For direct labor efficiency variance, the formula for that is standard hours multiplied by standard rate minus actual hours multiplied by standard rate. And again, this time both of them are equal, right? So it has to do with the, sorry, they are not equal. That's 13,000 to 9,000. So we get the standard is greater than the actual, so you get a favorable again. And 4,000, 400,000 favorable. Part C, explain each of the following items: an ideal standard and practical standard. And this has to do with the standard course, and it deals with each types of standard. Okay, now the idea behind these short, small kind of questions is that you should answer them in you could answer them in point form, but don't make your points too short, and always remember that a point explains itself because you will not be there to explain it for the examiner. Okay, ideal standard costing sets standards only attainable under the best circumstances or most favorable conditions. It assumes nothing that can go wrong will occur. Okay? Practical standards are tight and attainable, but attainable even under adverse conditions. It assumes that situations can occur which will make the attainment of the standard difficult, but takes this into consideration when setting the standard. All right, so these type of questions you have to look at the meaning of the, especially the meaning of the word here gives you a clue as to what it is. And here, ideal means the perfect standard, and it is that could only be attainable under perfect circumstances. You have no shutdowns and stuff like that, and no strikes, and your labor, you get the best prices attainable from your suppliers and all of that. Okay, practical standards are tight but attainable. Right, those are the key words that you need in answering these here. Okay, part D. I think this is the one that most students are waiting for. It deals with capital expenditure appraisal. Let's look at what is required first. Distinguish among the three given methods of evaluating investment decisions. So the three methods that we could see there are payback period, NPV, and IRR, internal rate of return, and net present value for those abbreviations. Next, calculate the payback period for project A. As this here, we notice it is blank, the one is calculated. Project B is given as 6.9 years. And 3. Calculate the NPV for project B. So you want the NPV for this project here. And 4. Suggest using the NPV criteria which project should be recommended to unique design given one reason. Okay, now although it looks formidable, this is quite simple. Okay, most of the calculations are already given to us, and we are given the present value interest factor in the total, so we don't have to go and add them up and multiply them out at all. We can just take this and multiply it by the annual cash inflow, which is the same for each one of the 10 years here and each one of the 15 years here. So instead of multiplying out each one, you can just add it up and then multiply the total, and the total is given to you here. Okay, so it's a simple affair, and let's get right into it. The payback period first is a method of investment appraisal which calculates how long the investment takes to recoup its initial cost, or how long it takes to pay for itself. Okay, so that's what the payback period is. The net present value is also an investment appraisal method, but it calculates the net present value of the discounted future cash flows of the investment. Notice it's future cash flows, right? We are looking at their value in the present. If the NPV is positive, the project may be accepted. If it is negative, then it will be rejected. The internal rate of return is also an investment appraisal method, but it calculates the discounting rate at which the net present value is equal to the zero. It is compared with the cost of capital to appraise the project. Right? The cost of capital is normally the borrowing rate or the rate at which they discount the future cash flows. So one of those two, and you're going to compare it with the rate that they calculate here, the discounting rate at which NPV equals 0, and appraise your project that way. That's the internal rate of return, IRR. Now, part 2 required the payback period of project A. At this stage, you may want to pause the video and go back and look at the data. You will notice this is the initial cost divided by the annual return. Alright, this is in fact an annuity, and divided by 115,000 and 7.4 years. 3. NPV of project B, that will be 621, the initial cost, 1000, minus, you take the total of all the present value, and you multiply it by the annual returns, and you will get a negative figure when you minus this from that. Okay, 17,091. 4. Project A is recommended because it's a positive NPV. We can see here project B has a negative NPV, it's in bracket, so you wouldn't want to consider this. And you would accept project E instead.